Tools of the Federal Reserve, Part 1. Interest on Reserve Funds, often called Interest on Reserves or IOR, is one of the Federal Reserve's most precise tools for controlling monetary policy today. Banks are required to hold reserves, either as cash in their vaults or deposits at the Fed. What's changed in modern policy is that the Fed now pays interest on those reserves. That seemingly small detail gives the Fed powerful control over bank behavior. Here's how it works. If the Fed raises the interest rate it pays on reserves, banks have an incentive to hold on to their money at the Fed rather than lend it out. Lending becomes relatively less attractive. As a result, fewer loans are made, the money supply grows more slowly, and economic activity cools. This helps fight inflation. On the other hand, if the Fed lowers the interest on reserves, banks are encouraged to put that money to work, making loans to businesses and consumers. That increases the money supply, stimulates spending, and supports economic growth. In this way, interest on reserves acts like a floor under interest rates in the broader economy. It influences the federal funds rate and helps the Fed guide short-term rates without needing to constantly buy or sell large amounts of securities. So instead of just pushing money into or pulling money out of the system, the Fed uses interest on reserves to steer incentives, quietly shaping how much banks lend and ultimately how fast the economy moves.